interest that you can deduct. Now, there are only two types of interest that you can deduct. It used to be like before 1981, you could deduct all of the interest you pay, whether it's credit card interest or whatever. But now you can only deduct mortgage interest and investment interest. That's interest on money you borrow to buy stocks or something like that, other investments.
Mortgage interest, what?
Investment interest.
So a business loan counts as investment interest?
No, the interest on a business loan would be business interest, and that would be deductible on your business tax return on the Schedule C generally. If you borrowed money, if you took out a loan to invest in a buddy's business, that could be investment interest in that case. But if you're investing in your own business that you're actively running, that would be just a business expense. Mortgage interest has three limitations. You can only deduct the interest on your main home, that's where you spend the most time during the year, and up to one second home. So if you're lucky enough to own 3 homes, well, your main home is wherever you live, and you can pick one of the other 2 homes to be your second home for interest deduction. A home, for purposes of this rule, is any structure that has a sleeping area, a cooking area, and a bathroom area. So that will, for purposes of this rule, a home includes an RV or motorhome and can include some types of boats, as long as they have, the nautical terms would be a berth, a galley, and a head. So as long as it's reasonable for you to live there long-term or at least overnight, then it would be considered a home.
So a cabin?
Yeah, a cabin. A cabin would count even if your cooking area is a propane stove and your bathroom is an outhouse, that would still count.
Cool. Purchase that. Living apartment.
So that's your first limitation. Your main home up to one second home. So if you have a vacation home in Florida and another vacation home in Hawaii, you have to pick one of those 2 to be your second home. Second limitation is you can only deduct the interest on the loan that you use to buy, build, or improve your home. So if you have, let's say you paid off your mortgage, or maybe you inherited your home, so it's all free and clear. There's no mortgage on it. But you take out a mortgage to pay for your kids' college. That was not used to buy, build, or improve your home. That's not deductible mortgage interest. Or if you refinance to get cash out in order to start your business, that's not mortgage interest. You can reasonably call it business interest in that case, but it would not be mortgage interest. If you ran up your credit cards, you've been going on tons of vacations, you ran up your credit cards, and you refinance your home to pay off your credit cards, you can't deduct that interest. So that's to be used to buy, build, or improve your home. The third limitation is your mortgage can only deduct interest on up to the first $750,000 of mortgage indebtedness, which is not an issue for any of our clients here in Alaska, but is an issue for some of our clients in Hawaii, and we do have some clients in California because real estate costs are so high in those 2 states. The last thing I need to say about mortgage interest is this concept of points. Points are when you're shopping for a loan to buy your house. Points are an amount you can pay extra up front to reduce your interest rate. So you might go to a mortgage company and they might say, well, you can have the rate you approved for is 7.5%, but if you pay us extra 1% of the cost of your home right now, we'll cut that interest rate down to 7.25%. That would be a typical deal. And they might say, for 2% of the cost of the home, we'll cut your interest rate down to 7%. That's points. And for points to be, then you can deduct those points because they're considered prepaid interest. You're prepaying interest. That's why they're willing to accept a lower interest rate, because you're basically paying that interest in advance. So they're deductible, and you have 3 requirements for them to be deductible. And the 3 requirements are that I guess there's actually, if I look in the book, there's 9 requirements, but the 3 that I remember are the points have to be for the original purchase of the home. It has to be your main home. And you have to provide at least that much upfront when you buy the home. So if your points are $9,000, so $450,000 loan, 2% of that is $9,000. So they might say pay this extra $9,000 in points for a reduction in 0.5% of your interest rate. As long as your down payment was at least $9,000, you can deduct those points. Right. If you get a second mortgage through like the VA or something like that, and they pay your down payment for you, since you didn't provide those funds up front, you can't deduct those funds. Mortgage interest has to be secured by your home. Usually, your mortgage interest is going to be reported to you on a Form 1098. And if you're paying your property taxes through your monthly mortgage payments, they'll usually also report the amount of property taxes you paid here in Box 10. Now, this Form 1098 is used for any type of mortgage interest, so it might or might not be deductible. It might belong on Schedule A, or it might belong on Schedule E for rental properties. And it might even be business interest. If you take a mortgage out to buy a warehouse to run your business out of, that would be a business expense. If your mortgage originated before December 15th, 2017, the limit is $1 million instead of $750,000. If your points are not deductible, you can instead deduct a portion of them every year for the entire life of the mortgage. So if you paid $9,000 in points and it's not deductible, 3 main reasons it would not be deductible is if it was like a refinance, so it's not for the original purchase. It would not be deductible if it was to purchase a second home, and it would not be deductible if you didn't provide the funds up front. And it would also not be deductible if you chose not to deduct it. Maybe your itemized deductions weren't high enough in that first year when you bought the house. If you don't deduct your points immediately, you can deduct them instead over the life of the mortgage, which would be 30-year mortgage is typical, $9,000 in points is fairly typical, so that would be an extra deduction of $300 a year for 30 years. Interestingly, even if the seller pays for the points, it's still deductible for the buyer. And sometimes the seller will pay a lot of the buyer's expenses in order to get the deal closed. They might say, I'm selling my house for $300,000, but we're going to pay these little costs for you, $6,000 in points, and that we'll waive $2,000 of closing costs. We'll pay your realtor their commission just to get the deal done with. Investment interest is deductible, but the deduction is limited to the amount of investment income you have in the same year. and then any excess is carried over to a future year. We don't see a lot of people with investment interest.